Good afternoon, everyone. Welcome to today's ASA Business Partner webinar, Lost in the Mail, Solving Refund Deliverability in Auto Finance. We are pleased to have you with us today. My name is Grace McGurn, and I'm the Communications Manager for ASA. Today's webinar is sponsored by Onbe. They are a highly engaged ASA Premier Business Partner, and we greatly appreciate their support. Your presenters today are Max Grande, Head of Automotive Segment Management, and Carrie Creed, Senior Director of Enterprise Sales. A couple of housekeeping items. Your mics and cameras have been disabled to ensure there are no disruptions. The webinar is being recorded and will be available to view on our website next week. If you have any questions, please post them in the chat. We hope you enjoy the webinar, and now I turn it over to your presenters.
Perfect. Thanks so much, Grace. Max and I are thrilled to be here, and thank you for everyone who has already joined. I can see the attendee list ticking up as we start talking. So we're really happy that you're here, and it's going to be a wonderful, informative webinar for you today. Max, how are you doing?
I'm good. I'm just trying not to spill this coffee on myself on my nice shirt.
That's right. Don't do that. I'm well,
how are
thanks.
Yeah,
I'm wonderful. Excited for today. So I'm going to have you kick it off. So why don't you take the first slide?
Yeah, sure thing. So first of all, I know time is precious and everybody's probably in back-to-back meetings. So I wanted just to start looking at the registration list, quite a decent turnout here today, and we're super appreciative of that. A little bit about me. My job is probably 90% of just talking. I've actually talked to a lot of you on this call, but talking to clients to really understand pain points, what's working, what's not working, what sucks about your current day-to-day and how that can improve, and a little bit about kind of the macro trends or how you're stacking your KPIs against what's going on in your industry. So what's unique about my role is kind of get a spot to get out of the weeds a little bit and connect the dots across these dozens of conversations that we've had within this space specifically. And we really wanted to bring that lens into this webinar. So the whole intent here is to pull out the value of what your peers are doing and what a lot of the companies in this space are thinking about, and package it up in a way where it's digestible. And hopefully at the end of this webinar, you kind of walk out of this with a little bit more of a perspective and an understanding of where refunds start to fall apart, why they're so painful, maybe processes if you're not necessarily plugged into some of the support and operational lift that goes along with a refund, depending on where you sit in that company, shedding a lens on that. And then a little bit about what some best-in-class lenders and how they're approaching the problem and what they're thinking about along with the payoff. So that's the intent of the webinar. But what I wanted to do just to start this off is there's really kind of three things that jump off the page when we've had these conversations in the space. The first is the pure count of delinquencies that are occurring today. It's the highest since 2010. And while that doesn't necessarily directly correlate to an increased level of refunds, it speaks volumes to just where your teams are spending time. So if you think about the day-to-day, maybe in the servicing and ops side of house, the repos that are occurring, the tracking down missed payments, the manual reconciliation of those payments, the charge off of accounts, all of those are increasing the workload for your team members. And when you think about manual refund processes and how individual team members are probably spending time researching return mail, trying to contact people that didn't cash a check, and then managing that all the way through to a shipment, it's kind of it's adding to that burden and that workload. So a lot of companies and leaders that we're speaking to today are actively looking at where can they optimize internally, and refunds is jumping off the page because it's a relatively low lift in order to start to point resources at higher value and higher impact work. So that's number one. The second is, and I'm sure just a lot of compliance folks on this call, which is great. So probably top of mind on some of the regulatory components here, but we've seen a ton of headlines in the past, call it 5 years, just on some of these pressures that have been changing with regards to CFPB enforcements, UDAP enforcements, and we're talking like tens of millions, if not hundreds of millions of dollars in fines, depending on the severity of those enforcements. And what we're seeing is naturally there's the timing component of it. There's the follow-up, the notification, doing your due diligence on ensuring that a recipient received that refund. And then there's also an increased focus on achievement. So we're seeing more and more participation at that state level overall. And these states have some nuanced requirements, and they're actually leaning into enforcing, are you managing a shipment properly? That's kind of the second bucket that we see with regards to themes that are jumping off the page. And the third is purely competitive pressure. So I'm sure literally everybody on this call has probably spent, call it the last 5-10 years, investing a ton of time, energy, and effort into optimizing ways to receive payments in. So being able to accept payments online through different form factors, cards, bank accounts, mobile wallet transfers, all of these great, cool things. But when you think about the best in class, and I know we're all best in class here, but maybe think about like the Taylor Swift best in class lenders on this call. What they're doing is they're taking that same amount of energy on the inbound side of the house and flipping it to the outbound. Because when you think about an exiting customer, that refund, it could be likely the last touch point that you have with them. And a lot of these individuals are starting to really lean into that as a way to differentiate, to be able to accelerate the payment, to provide choice, to provide that lasting brand impression, which can go a really long way when you think about driving loyalty and driving engagement. So those are the three that jump off the page. And when you think about how that actually ties into refunds overall, well, we're going to spend the next few minutes and carry what like 10, 15 years, probably your experience overall in refunds. So
15,
we want to start.
You got it.
Yeah. So we want to start to pull this down, kind of into like why and how this starts to show up in your business as a pain point, and then start to lean into maybe how you can measure it and how you can solve it. But I'll pass it over to you, Carrie, on some of the next steps.
Perfect. Thanks, Max. What a great way to kick this off. So, you're exactly right. I've been working in various industries talking about refunds for a decade and a half. And what's astonishing to me is that in the beginning, the focus was, I just need to get the payment out. This is my last experience with this customer. I don't necessarily care. I didn't care that I was issuing checks and it was bad, but I can save money. And so let's just change this process and let's just forget about it. To now, the focus is really like, no, the customer experience is paramount. It is crucial for us that at any given point, no matter when we're touching that customer and interacting with them, it is the best experience they can possibly have. And so that has really shifted, not to say that refund programs from the start didn't have a great customer experience, because they did, but yet the client wasn't necessarily always expressing that that was their number one focus. And right now we're really hearing that that's a top 1 or 2 focus for them. They're tracking NPS scores. They're really cracking down on, we want to make sure that this experience holds true, because every other experience they've had with our brand has been exceptional. And we don't want the final experience, if this is for a final overpayment, let's say, from a refund perspective, to be not in line with previous experience. So it's just no longer kind of that old, like, set it and forget it, like the old infomercials for like the crock pots of like, let's just get it out there. We don't really care. This is something that people are wanting to do in a way that's crafted and intentional from the start to the end. And that's been a really great shift that I've enjoyed talking to lenders about. And while I've worked in these various industries between telecom and healthcare and auto finance and utilities, and as these refunds have evolved and as we've learned more about customer preferences regarding choice and flexibility, we've also realized that these clients, such as all of you on this call, have a very hard time figuring out what your true all-in check costs really come down to. And as we get deeper into these conversations, and to Max's earlier point, him and I and the rest of the segment management team, are having these daily conversations with large banks and lenders and captives and partners about these costs of the check and what really is that. And sometimes we hear that it's just like this small amount because that's their third party management cost to cut that check. Gosh, there's so much more to that. And I'm going to go into that really soon, because it's no longer just satisfactory to think that your check cost is $1 or 79 cents and that's it. And you're just sending that check file off and you just hope for the best. And by the best, it's that somebody actually receives it and then somebody actually cashes it. So there's a lot of steps to the process, and every piece of that pie has to go perfectly in order for that customer satisfaction to be as high as you want. And I hate to break it to you, but that process, if you're using checks today, is not going perfect 100% of the time or even 50% of the time. A good example of that is this little guy that my husband got. I've kind of crossed out all the sensitive information on this, but if you can see, I'm not sure if it'll allow, but this is a dollar check. It was given to him on August 5th. It's not cashed because my husband falls in the category of 53% of people just are too lazy to cash a check that's under $50. Now, he was like, I'm not going to take the effort to cash this dollar check. Now, I'm definitely the other side of that. I'm the 47% of people who would cash it just because I'm pretty type A. So I would be cashing that. My husband's not. And that's a great example of this check just costed this organization a lot more money because they just, he decided not to cash it. So let's go into this flow, this exception process, and see if your eyes are kind of wide open regarding what's really happening with these checks when they go off the door. So that typical check-based refunds flow is right here on the left. You do all the work with your team to determine that John Smith is owed a refund for $612.47. And you send that check file either to a third party or to yourself to manage that process and cut those checks internally. Some of you I hear are still actually signing checks, which is such an incredible manual process to even cut your own checks. But if you're still even signing them, that's a whole nother level. And so you're working so diligently internally to get these checks out the door. And they're going through the Postal Service, which, by the way, the Postal Service had come out a couple months ago saying stop putting checks in the mail because fraud is increasing by a couple 100% year over year because of check fraud. So stop doing that. So they're kind of screaming, even though I'm sure they want your postage for it, but they're screaming, stop sending them. And you're just kind of going like this. You're kind of just like, gosh, I really hope that gets to that intended recipient. I really hope they live at that same address that when they first signed up for this loan 60 months ago, that they still live there, because if they moved over 6 months ago, their forwarding address is going to be expired and then they're really not going to get it. You're hoping for the best. And the ideal path, I'm not even call it the ideal path because that person, let's face it, doesn't really want the check. So maybe just the current path, I'll say. The current path is they get it and they actually cash it. And that's great, right? Now, I will kind of go into how the cash commingles with the rest of the stuff in their checking account and that the refund experience is kind of lost. And did they get that warm and fuzzy feeling about it? Probably not. And not a lot of communication, not a lot of branding. By the way, this one, I know who sent it because it was a logo, but I have no idea why this dollar check came. I have absolutely no idea. There is no language here. So that would take a customer service call. There's nothing. So what happens if that check doesn't get to that person or doesn't get cashed? Well, there's 3 areas. And the first one is that return mail. 15% and higher of checks going out are being returned back to that bank. And therefore, you are finding out your operations teams are pulling their hair out because they are needing to log that check. They're having to do outreach attempts. They're looking into finding a new address. They're finally getting that new address and making a reissue. They're making a stop payment on that check. And by the way, to get those checks back to you, you're paying really high UPS costs or FedEx costs to get those checks all put in a pretty little box to get them just mailed to you to start this process. So again, costs up, up, and up. That second exception process is that customer inquiry. So that's somebody calling in to say, again, what is this? Why am I receiving this? And is that amount even right? Am I even trusting it? Because if it's a high amount, I might be thinking, should it even be higher? Or this dollar, should it be higher? Or what is it even for? That customer service call is the most expensive type of customer service call because it only works if they reach a live rep. Can't really do this any other way. They have really specific questions to ask. So they're also possibly saying they lost their check or their name is spelled wrong. Or if they're given those real old school checks that go out a lot, the one that's folded, the tri-fold with the perforation on the edges. You ever get one of those, Max? That you have to fold it and then do the tear off and it has the glue on the top?
Terrible at tearing those. Yeah.
Right. Terrible at tearing, has the glue on the top. I'm a good tear on the perforation, but we get me that piece of glue. And I've definitely ripped a check. And then I was like, okay, if I tape the back of it and try to do a mobile picture, maybe they won't notice that it's ripped and I'll get it through the imaging security. And I can't remember if it worked or if it didn't work. But Most people, if they're ripping that check, they want to make sure it can be cashed and they're calling for another one. So again, lots of research, lots of operational issues, lots of cost coming to your cost centers. And then lastly, third is my husband, a non-deposit. And so what happens in that case when there's a true non-deposit is that in that case, and in all the other cases, when those reissues aren't cashed either, it goes to escheatment management. Now, escheatment management, Max alluded to it a little bit, is the most expensive part of the process. And it happens when that check goes uncashed. Now, there's a lot of compliance legal folks, so you guys and gals on the line definitely know what escheatment is. But for anyone on the call, basically, if that check goes not uncashed, those funds can't go back to that corporation, can't go back to that bank, can't go back to that lender. It has to be forfeited to the state. And you have to be working with somebody who has expertise in that in all of 50 states to escheat at the appropriate time, at the applicable rate, and making sure that you do all the due diligence that needs to go on beforehand. If you're issuing checks, that person is you all, because those checks, even when you're working with a third party, are written off of your own account. And when the checks are written off your own account, you're responsible for the escheatment. And I don't think any of the people on the line today, listening to this webinar, or any of the clients that we work with today, have any fantastic expertise in escheatment. There's an escheatment department at your organization, which I'm sure they do a fabulous job, not wanting to throw them under the bus at all. But keeping track of these, ever-changing regulations and keeping track of all this from a compliance perspective and those very, very high multi-million dollars and hundreds of $1 million of fees when the states crack down that you've maybe done that incorrectly through an audit is what you want to avoid. And that's definitely a benefit we'll get into of working with a program manager who handles that for you. So if you want to go deeper into the cost summary of what these exceptions really mean, I'm going to have Max kind of go a little bit further into this for you.
Yeah, I love that, Carrie. I know we were talking last week and I pulled up a check with my daughter's scribbles all over it. And I think it just goes to show you how painful that process is for something that is so antiquated.
Yep.
Like the last time I wrote a check, I don't know, it was like 20 years ago. But so what we're going to do now is we're going to spend a few minutes just to start to give you benchmarks, because when we're having these conversations with your peers in the space, we're taking notes, we're thinking about this, and we're starting to draw comparison points, if you will, or points where if you don't know specifically how much this costs, but you're doing it, we can start to plug in certain estimates based off of what we're seeing in the space overall. So as Carrie called out, probably I'd say it's probably around 50-50 now, but I'd say half the time that we're coming into these conversations and we ask what your check cost is, it's like $1 to $3, right? As Carrie called out. And you're not wrong about that. It's the postage, it's stuffing it in an envelope, maybe an FTE, right, in order to manage that process overall. But when you start to look at all of those three lines and the implications and the ballooning cost of each of those, that's really only 20% of the cost overall. So that $3 check fulfillment, it's actually probably costing you 15. And that's really, as Carrie called out, what we've observed is because these check processes are so disparate across the organization at large, it can be cumbersome to come to that one single number. But what we wanted to do here is just start to give you a little bit of fodder, right, to go back to your teams and start to think about, like, what is our actual exception process? What are we actually being charged from our banks for certain exceptions, right? So that first bucket, like through and through, the biggest component of this is when a check doesn't get cashed by that person or it has a bad address, right? So that's kind of on that right side, the exception process overall. This is where Carrie was calling out. You have people calling in that customer support, can't direct them to IVR. You have to have a live contact there. What we see when you think about the true best-in-class lenders out there, they're really taking 3 steps on any return mail that's coming back. And I know a lot of you aren't doing this. If I talk to you, I know a lot of you are probably getting that return check and you're shredding it or you're putting it away and then you're just waiting for a shipment to occur. But the best-in-class out there, they have 3 contacts. So you mail a check out, bad address, doesn't get delivered for whatever reason, you get it back. They're making a research on that individual account to see if an address has been updated from the time that check was mailed out to when they got it back. Generally, that's probably like 3 to 5 minutes per item that comes up. You're pulling up reports, you're looking at the account. What a lot of these players are doing, which is next level, is they're actually reaching out and they're contacting that person. They're making an attempt to get an updated address on file. And you may be sitting there and thinking, wow, that sounds a little bit overkill. But if you think about the UDAP, potential violations for not delivering the funds, and then you think about the downstream, what happens when somebody pays off a vehicle? You have to mail them a title. So if you're not capturing that updated address information, you're going to get an exception on that check. It's going to go to a sheetment, and you're going to get a return mail on that title as well. So they're bringing that up and they're contacting that individual. They're making a call. They're sending them a notification in the app. They're emailing them. They make a second attempt after 30 days. And then for all the compliance folks, when it comes time to due diligence, they're doing that initial letter out saying that your funds are about to be issued to the state. So 3 attempts. That's what we see for the best in class. And they're willing to do that because they're trying to stay off of that UDAP radar, right? So they're making that investment, which actually starts to balloon that even higher on the $15 range. The second thing that we see is if you've ever looked at your bank statement or you're working with a third-party provider, stop and reissues are like $30 a pop. And the number of times you get somebody calling in and say, hey, I misplaced this check, I can't get it, and you have to do a stop payment on the check and reissue it. Those costs also, we talk to some players out there that are doing 10, 15% of those. And when you think about your maybe $3 versus a $30, your blended check cost overall, just for fulfillment overall, starts to really creep up. The third thing, and we talked about this maybe a year or two ago, but we went really deep with bank account statements with a partner of ours. And it was so interesting. And I'd love for you all to, if you have access to these, to take a look, because the bank statements and the line items on those statements can actually change what they're called month over month, which is really interesting. So when you think about all of like the positive pay fees or perfect presentment fees or individual reconciliation fees, if there's maybe an exception that shows up on a report, oftentimes banks are charging for that. Not only are those prices going up, but literally the name on the item on the statement changes month over month. So it makes it nearly impossible for you to go back and reconcile from a bank perspective. But they're doing that intentionally because they want you off of checks too, right? It's kind of a lose-lose situation. It's painful for them, it's cumbersome for them, it's expensive for them too. So they're naturally passing that cost along. So that's all of the exception bucket. The unclaimed property Carrie touched on, I want to spend just a couple more minutes on it because what we've seen is generally this touches 3 different departments. You may be thinking like, yeah, I've got my team underneath me. We're running the achievement shop. We get the report. We make sure that, you know, we're fulfilling our due diligence required and we're issuing to the state. But what often goes overlooked is that first 6 months to a year period where the servicing and ops team is actually getting a report from your compliance group and they're tracking those H payments themselves. So you're getting duplicate work across different departments. And when you think about the number of reports that need to be reconciled, oftentimes these reports are manually pulled, manually merged, the errors that occur with that, the 4 different systems that you need to log into in order to get it. It's touching those 2 teams. And then ultimately the final remittance, the true achievement over to the jurisdiction, often driven from the finance and accounting team. So all of these reports need to line up. Teams need to be chatting. We've seen a lot of groups that batch this up and they'll do like quarterly sprints where they have a team of 5 to 8 people and they're heads down on just making sure that these reports all line up. So that's that bucket as Carrie was calling out. When you think about, yeah, the exception component and that driving up cost, but then the actual per item sheeted can really balloon too, because not only do you have the cost to actually a sheet, if you're doing the reporting, if you're mailing the letters and you're owning all of that, but you have that internal work that needs to be contemplated as well in order to get there. So it's amazing how fast when you actually start to sit down and you maybe look at like 5 to 10 different data points across your teams, your $3 per check, you're walking out of a conversation and you're like, oh my God, I'm actually paying $12.50, right? And that is what we have seen as just key to being able to build momentum internally, because you know it on this call. It's a painful process. Your servicing and operations team knows it. It's the number one thing that they say when we talk to them is, yes, we want to change this, but we have trouble getting momentum around it. So you need to be looking at this entire picture, right? Because this is truly the cost on your business, not just the fulfillment. So we're going to
Max,
jump.
what about also the finance companies we've talked to that says like, we haven't been cheating. We know we need to. We just don't know how. Like, please help us. There's also that element too of not even knowing where to start and just knowing you're at a major vulnerable spot of risk and fines. That, you know, so there's that area as well to consider too.
Yeah, we've talked to groups that they've come to us not necessarily through the digitization perspective on, hey, we want to make these checks digital, but through, hey, we know we have growing asset like liabilities on our book related to a shipment, and we need to take care of it, right? We want to make sure that we start to get into good compliance. We want to understand how this actually works, but we don't want to build a team of 4 people and take 2 years to get that expertise. We want to offload it. So that's a great call out, Carrie. We see that more than you would think, quite honestly.
Exactly.
So what we want to start to do over the next few minutes is really start to shift around. We've got a kind of a good understanding of the macro. We got a good understanding on the walkthrough of how a refund check actually flows. We just talked about costs. So now, how do you actually start to go about solving this? What does it look like to actually nail this solution? So we split this up into two different groups. I'll call this first bucket really around, I'll say, like consumer orientation. So the first one is event-driven issuance. And I know there are groups on this call that are doing internal balance transfers across their GLs in order to move money around and pay out of a single account. That internal reconciliation is incredibly painful, and it's based off of a check process. So when you actually start to think about, can we change this and can we start to bring this upstream, you actually can break apart your internal processes and avoid reconciliation completely, because you can start to issue out of a different account, right? Which gets really cool when you start to think about, how can we actually make this more trigger based? How can we carry her refund faster and avoid some of that in between, where even if it's just a couple of days when you're up against the line on having to get a refund out for this cancellation on this gap policy, those couple of days go a long way. So the event-driven issuance, when you start to think about, if we were to break this process apart completely, ideally, where would we put the trigger point for issuing a payment out? And what can we cut out? Manual internal processes, internal reconciliation, that gets really powerful. The second is embedded choice. So it's one thing to say, okay, like we get it, we want to go digital, we're going to do bank transfers. That's great. ACH works really well for a certain group of people, but not for everybody. And that's where when you start to talk to different providers and you start to look at what does good look like, this embedded choice goes a long way, because we talked about it on the internal side of the house. We were trying to get money in. On the outbound piece, depending on where that person is in their life, whether it's different demographic, different age bracket, or literally even the time of the month that they're receiving that payment, they may opt to choose a different payment at that point in time. I may have a massive bill due tomorrow that I'm a little short on cash, and I need a real-time payment to my bank account, or I need to have a virtual card to actually go and do a bill payment transaction. So that's where, when you start to put kind of that choice for liquidity in the consumer's hands, that goes a long way with regards to being able to boost that NPS that Carrie was talking about. We've literally talked to groups who they look at a paper-based refund and they look at a digital refund, and it's literally a 20-point NPS difference on those two because of that liquidity. And when you think about how you can drive consumer loyalty and have that engagement, there is no better time to put your brand in front of somebody with a really slick payment experience.
And when you think about it today, like before you get to the third, today you're just kind of giving everyone that very basic check. And depending on the demographic of the person, are they in their 20s or are they in their 80s? They're going to perceive that check very differently and choose to do something very differently with it than if they had that freedom and flexibility to choose how to spend, or use mobile wallet, or use PayPal, Venmo, push, or spend the card at a point of sale. And so by providing and enabling that choice, to Max's point, you're increasing customer satisfaction because you're providing choice. You're letting that individual choose what works for them, not only as a financial tool. Are they living paycheck to paycheck and need this money right now? Are they able to deposit it and later and put it in their checking account to earn interest on? So you're no longer forcing something down at them, but really enabling them to choose themselves. And that's why we know 88% of people who have been polled would prefer this choice, because it really increases that satisfaction for the program.
Love that. A lot, and Carrie, I'd love your perspective on this, because I know you often lead with this, but a lot of companies that we speak to, one of the first things that they bring up is, well, what happens if they don't engage with that email?
Yeah.
Right? Maybe we've had this huge digital push. We're trying to get everybody on our mobile app. Maybe we have like 70-80% coverage of email addresses, right? Is that kind of like what you hear on your day-to-day?
Absolutely. Yeah. And that's a big concern, because people say, like, well, what if I don't know if this email is correct? What if I have their old hotmail.com email? By the way, I heard that some people still use that. So I'm not making fun of anyone on the phone that actually has a hotmail.com account. But like, you don't know if that's the email that they check daily, or one that they signed up for some junk marketing purposes and they're not really checking it. The most important thing to realize is that, from an Onbe perspective, since we have the most experience in this area, we know the value of how important the sensitivity of these funds are, meaning that they're Reg E. And so these are all consumer funds. These aren't corporate funds. This isn't an incentive program. This isn't just fun money that you're sending out to thank somebody for being a part of your program. This is the customer's money. And so they have a right to get it and have a right to spend it easily and conveniently the way they want. And so, to Max's point, like, if you have an email address for somebody, you don't have to necessarily worry that maybe that person doesn't use that email anymore, because since it's Reg E, from an Onbe perspective, we're always going to send a second form of a payment out to make sure that we satisfy those needs and that refund gets delivered. And we do that by then sending a physical product out, USPS, right to the cardholder's home mailing address. So we have those things thought through. We know the importance of that. We know the importance from an auditing perspective and getting that information back to the regulators. And so that's an area that we're really buttoned up to make sure that that refund gets to the intended recipient.
Yeah, I think that's huge, because you can also go and you can talk to a bunch of, we'll call them monorail providers. And if you're just adding maybe one or two different rails in order to provide that choice, but you don't have that fallback option,
yeah,
you're missing a very big opportunity in order to ensure best attempt in the delivery of that payment, right? So that's where that last item, modern rails with a fallback, often falls into play.
And it puts the lender at risk then, right? Because if the provider is sending the payment, but it's not reaching that person and there's no second chance there, it's the lender that's ultimately at risk. So that's something that we always do our best to avoid. And that's why we've structured our program to eliminate that risk and to have the best experience for the users, to have multiple ways of getting that payment successfully.
Yeah. Let's jump to the next three, which are really around, I'll call them more corporate orientation, right? So when you start to think about, hey, we're going digital, what are some things that we can contemplate with regards to injecting into the flow to make sure that the person who we think we're sending the payment to is the one who's actually receiving the payment? And when you start to digitize that transaction, you can start to do some really cool things with injecting MFA or injecting challenge questions into that flow, where maybe you need to validate like your date of birth or account number before going in and accessing the payment. With a check, you can't do that. And Carrie was mentioning the dramatic increase in check fraud overall. Literally anybody can walk up to my mailbox right now and take my check and make a couple adjustments and go and cash it, right? So that added security, the identity and the fraud controls around it, and then being able to take that and use that as really a differentiator overall, because not only are you saying, I'm trying to pay Carrie came in, she authenticated that payment, but taking that back and taking it internally to be able to differentiate it as a business overall. Exception minimization. So we touched on this briefly, but if you have a bad address on file, you're mailing a title over that individual. So when you start to digitize that payment, you also introduce opportunities to interact with that person. So what we're able to do is when you send that email, you click that link, you go in, you access a payment. Being able to find providers that can also validate the address or have that user change the address at that time of payment and receive that information upstream in order to maybe change your additional notifications that are going out, the titles that are going out overall. So refunds, you can think of them kind of in a bucket, or you can think about maybe there are tentacles into the organization and other processes that we've seen overall. And then the last component around compliance, I know we've hit this a few times, but we wanted to make sure that the people on the call were satisfied here. You got to look at, and Carrie, lovely run through on that last slide, like you have to consider providers that know their stuff overall. We see a lot of providers in the payment space overall that maybe they have a couple bits and pieces of this, but it's not built from a compliance framework ground up. They're not CFPB compliant. They're not considering Reg E. They don't even know what Reg E is. But when you start to build a payout solution that is guaranteed delivery of funds via that email delivery or that physical, you start to do things like boost notifications going out. So when you think about, can I prove to the regulator that I had best attempt at delivery, that I actually reminded them that they had a payment, that they engaged with that transaction overall. And what's really slick is being able to timestamp the individual checkpoints on that transaction along its life cycle. With a check, you mail a check out. I mailed it on this date. It got cashed 2 weeks later. I have no idea who cashed it or where it went, but it got cashed. With this, you can see who engaged with it, where they engaged with it, what time they engaged with it, how they engaged with it, and you can really start to build these audit reports that you can take internally. And if you've ever gone through an audit yourself, you know that kind of last minute scramble on being able to have to package all that stuff up. But you got to work with the right providers that can do that and can do it in a way where it falls into all the different feed guardrails. When you start to think about what are you assessing from a fee perspective, are you charging convenience fees? When can you charge convenience fees? What payments do you need to make for free, et cetera. So those are, and Carrie, if you have anything to add, feel free to. But those are really the kind of the two buckets: the consumer side, the corporate side, and call it the 5 or 6 things to contemplate on what is a good solution.
Yeah, that was a fantastic summary, Max. And I hope as you all have been listening to this, if you came into this meeting thinking, well, I know my organization issues checks and they've been working for 30 years or even more, and it's just been fine. I don't think there's an issue. Someone's telling me that we should probably focus on refunds. I hope we've opened your eyes up to the fact that there's a lot of issues that's going on within your organization, most likely, and there's a lot of teams under a lot of pressure and under a huge cost center that can be avoided. And you don't have to take it from me and Max. A good example of this is John Mason, SVP of Operations at Westlake. A very respected finance company is one of our clients, and they launched with us a few years ago. And with them issuing over 120,000 checks annually, they were able to digitize 100% of those and absolutely practically eliminate all of those manual processes and the costs associated with that. And so, to see such an organization who's really tech-centric and really innovative, really take advantage of this fantastic solution, and then see the benefit really occur so quick for them and have such a great success was a fantastic case study. And a fun fact about them, they actually launched their program, I should say, in under 55 days. And so typically our implementation is around 5 to 6 weeks, but there's a lot of times that clients need more time for prioritization or, developing the file to send to us. And that lift is quite small, but sometimes there's just some needed time to, work with marketing to design the different areas of the program. But Westlake was all over it, and we were able to move as fast as they wanted to move. And for the fact that they launched their program full out in that 55 days was pretty awesome. And they're having great success because of it. So, I hope that you've seen that the costs that come out of these checks today are being absorbed by multiple areas of your organization. As you probably you can remember us both saying and how it's really hard to keep track of what that cost is, because those banks changing those fees, changing the line item and what they're calling those fees, and really understanding the true cost associated with it. But it's there. And Onbe's goal is to not only better your customer experience, but reduce those costs by 70%, up to 70% of those costs, and eliminate the fraud and the risk you have with your program today. So it's a really rare occurrence to, of all the different products and solutions in the market for a variety of industries, it's so rare to find something that not only reduces costs, eliminates risk, offloads compliance, and increases customer satisfaction. Like usually there has to be, if you're increasing customer satisfaction, you have to pay more for it, or you pay less for it and your customers really struggle. But this one is that win-win of a situation. And so we hope you see the value of that, and that's why the more and more conversations that Max and I are having, and the more and more times I'm attending these auto shows and hearing from lenders and banks and finance companies that these conversations are occurring more now than ever because of the pressure from compliance, the pressure that they're having to make this experience better, and the pressure of the customer experience needing to be front and center and increasing that NPS score and tying it to it. So I hope that you see that this product can really transform your whole operational team and also the way that you deliver payments today. So on that note, we greatly appreciate your time and attention listening to this informative webinar. We hope you took a lot from it. We have some time to open up for questions. So if you have a question, feel free to drop it in the chat, and Max and I will pick those up and be able to answer them. And if we have so many questions that we run out of time, we'll be happy to follow up with you afterwards. So, but please ask us anything you'd like to learn. We're an open book and love to talk about this all day long. All right, I see one. See if I can pull that one up. Hi, what are you seeing that shows people really prefer digital payments over checks? Great question. So Onbe puts out a payment study every year, and we identify different consumers based on industries, interests, reasons for payment. And our recent one was actually geared towards auto, and we identified a segment of folks who have received a refund payment for their auto loan in the past, either an overpayment, a gap insurance refund, a product cancellation, and specifically asked those consumers direct questions regarding that refund and how they received it, how they would prefer to receive it, what they would change about it. And from that study, we identified that 88% of those participants would have preferred a digital solution that provided choice and not having more of that archaic, slow check. Because let's face it, once that check gets to you, and going back to that exception process, once it gets to you and it actually arrives at your doorstep, the average person takes 1 to 3 days to actually cash it. So if you're guilty of having a stack of mail on your kitchen island, like I am, that might be in that stack of mail for a couple days. And then once you deposit it, either driving to the bank ATM or using mobile deposit, it takes 1 to 2 days for your receiving bank to even have those funds available. So not only did that check take maybe 2 weeks to reach you, but it also took an additional 5 days for those money to be available for you to actually spend. So 88% of people want it faster and want more choices. Great question. All right, Jeff, what other solutions do you have when 95% of refunds are to companies, not an individual, and the company wants the physical check? So good question, Jeff. Onbe truly focuses, our sweet spot is B2C. So we really are looking for that consumer who would be getting that residential person, that consumer who would be getting that check today, and digitizing it for them. You're right. Companies, depending on the size of the company, we do have some small business refunds being paid via digitally, but it might not be always the right fit. And we can certainly have a conversation with you regarding those types of payments, and then determining, is a digital payment the right thing for them, or is a check better? And we also kind of we have a B2B platform that we can make something like that work in that way, and I'd be happy to have an off conversation with you as well. And Max, I'm not sure if you want to build on that a little bit more.
Yeah, I think the real-time payments through push to card we see quite a bit, because while check may work and it may fit into maybe their existing AR system, the immediacy of some of these newer rails can help accelerate their cash flow. So sometimes it just takes a conversation, especially if you're starting to see like an increased amount of those payments, and people maybe start to raise their hand to say, like if you put out a poll and they raise their hand to say they want that digital, starting to think about that. And then naturally ACH we see quite a bit as well. So those three generally come top of mind, but that's a great question.
And then another one, how are others in the payments industry approaching this challenge, especially with the recent CFPB guidance? And where do you see Onbe standing out? Do you want to start that one, Max, and I can jump
Yeah,
in after?
yeah, happy to. So you kind of see the influence of the CFPB can ebb and flow overall, right? So um, depending on where we are with certain administrations or where we are with a time period overall, they can come in pretty heavily. But at the end of the day, the OCC is really the one that's driving a lot of the guidance overall. And what's interesting, and I'd say in the past couple of years, we've seen more state AGs starting to step in. When you think about the fines that are being imposed, or maybe some of the assessments that are occurring, it's driven at that state level, and that can actually be harder because there's nuance to each state. What they focus on may be different. What the red flags are might be different. Um, so when you think about how the players overall are kind of approaching this with regards to maybe CFPB starting to take that step back, is that there's actually more nuance. So thinking about players that have kind of that 50 state experience that can be able to satisfy state AGs or have experience on working with some of that changing nuance. There's been a couple, California and New York recently put out some different regulatory adjustments, and those are good examples where they're actually at that state level expanding UDAP enforcement. And there's actually a couple of years ago, it was like a $1.3 billion fine on a very big lender because they were wrongfully applying payments. They had bad timing around it. They had bad timing around when the refunds were actually being delivered. So that tipped a lot of the state AGs overall. So we actually see it being harder with some of that CFPB changes. And a lot of the players in the industry, whether it's truly payments or it's maybe more of that compliance angle, starting to focus around maybe Texas might be different than New York or California. And I think that's where Onbe really shines. We play in a lot of highly regulated spaces. When you, as Carrie meant, I mean, she has had that firsthand experience, but you think about working with banks like we do, you think about being in healthcare like we are, obviously auto. I think what's super unique about auto is, yes, healthcare is super regulated, for example, but auto has that operational grind where there's literally like 100 different refund triggers that can occur, and being able to track that nuance and how that should be applied and when it should be applied. That's kind of where you all have a challenge where maybe some of the other spaces don't.
Yeah. And the second part of that question was, where do you see, Onbe standing out? And Max, you made some really great parts there, points about, the work that we've done with the CFPB. And what a lot of folks don't realize is that, I know the CFPB right now, it's all uncertain, but they have hosted a publicly available website where, in order to be kind of fully compliant, and I use air quotes always because the CFPB doesn't fully say you're approved from a compliance perspective. They just tell you when you're not approved, not when you really are approved. But the final step for that true approval is posting your terms and conditions to that publicly available website for the type of solution you're working on, the type of refunds, and the T's and C's associated with that. And from in the auto finance industry, Onbe and our prior legal entity, Northlane Technologies, is the only provider that shows up on that site. So we're really proud of the experience and being the leader in this space. And to Max's earlier point, there's others that are really trying to do something here and just really not familiar with the importance of this solution being Reg E, the importance of how the lack of fees or how fees are structured. And they're trying, but it's a risky endeavor. So we're really happy to be leading the charge and consistently being successful.
So we've got one more, Carrie. When it comes to digital disbursements, who ultimately carries responsibility for unclaimed property?
Yeah, so I can take that one. I love talking compliance. It's probably rare for a salesperson to like compliance so much. I think it's just because we're always such an up and up that it's easy to talk about. So since the funds get sent over to Onbe's BIN sponsor bank, that bank and Onbe would be responsible for that escheatment management. So by working with that program manager, hopefully at Onbe in this case, we'd be fully liable for that escheatment. And we would need to, which we are, maintain compliance with each of the 50 states. And then we'd be sending reporting back for you on that. So that is one of the largest benefits of being able to offload that escheatment process to us for this program.
Yeah. And this last one is, what do you recommend should be the retention time frame? How many years on average of the data for these disbursements since they're multi-state audits? So generally speaking, in the payments industry, 7 years is usually I'll call it like the gold standard. We have seen up to 10 years, certain states may look back at. So while I'm not here to like put a rubber stamp on, and Lewis, if you're out here listening somewhere, I'm sure I'm gonna get a message from you eventually, but that's generally what you should just think about looking at, is kind of that data retention in that 7 to 10 year period.
Perfect. Well, if that was the final question, again, thank you so much for attending this webinar. Fantastic questions. We really appreciate it. We hope you're leaving with a lot more information. We hope there's gonna be a lot of internal conversations occurring regarding your operations team, and where these check payments and costs are coming from, and maybe doing some internal analysis on your side. We will be reaching out with a recap and the recording for the webinar, and I look forward to potentially be having a chance to speak with you all on an individual basis in the near future. But thank you again for tuning in. Max, thanks so much for being here.
Yeah, good to see you, Carrie. Appreciate you all.
Well.
All right, bye now.
Thank you all for attending our webinar. Just a reminder that the recording will be available on our webinar page next week, and we hope everyone has a great rest of their day.